The headlines that have been happening today, the back and forth, the whiplash that we've seen in markets, how are you making sense of that from an FX perspective?
First of all, thank you so much for having me back. But I think it's a very clear sign that markets are purely now hinged on the duration and the extent of the conflict. Everyone's just waiting for signs of that. But it did show a very clear sign that markets are also very happy and willing to fade the moves you've seen in the last couple of weeks. And they're looking for that glimmer of hope and optimism. And hopefully the good headlines you've seen come over in the morning. Hopefully if they get dragged out, then potentially you could see maybe outside of the oil market, other asset prices could go back to where they were. Oil markets are potentially the only ones where we see some permanent risk premium will remain embedded, given some of the energy infrastructure which has been destroyed. Maybe the new baseline for oil prices is not 60 anymore, but closer to 80. Whoa. But outside of that, asset prices, other than that, might be able to go back.
You said permanent risk premia. I mean,
a little bit more medium term, not in the sense that it would remain, yes, but it will likely remain for a few years, especially because some of the energy infrastructure which was destroyed, rebuild, right? It will take time and years to rebuild that. And even if there's a ceasefire, think about it, like you cannot do away with the risk of Iran feeling emboldened and then attacking again.
Can we go there? Because I think it's safe to say any of us who remember 9/11 or just think about the region as a whole, and you think about Iran's history with the United States, it's not been a good one for a long time. And you do wonder, do you leave a country, an entity, a regime that is even angrier at the United States? And I don't know that we can get a read on that yet. I think even the president was talking earlier. Did we overhear him saying something like that maybe he and whoever the next leader would be kind of having say in what happens in Iran next? So there's just a lot of interesting things going on. But are we wrong to think about, have we created a bigger enemy here? And maybe some disconnect, too, with the region as a whole beyond Israel, who probably maybe weren't prepared for all of this fallout and destruction.
The way we're seeing risk scenarios right now, there's only two probable outcomes. One is potentially a continuation of the good headlines you've seen, where potentially both sides have some sort of a ceasefire, like come to some terms and agreements on the basis of that, and both sides will be able to claim victory from that. I'm sure the US will say that we have eliminated part of the supreme leaders there, but Iran will also be able to claim victory in a certain sense. So both sides get that, asset prices come down. In that environment, we actually expect a good amount of selling pressure on the dollar to resume.
That's one scenario. What's the other one?
The other one is potentially if the talks do not go well, potentially this becomes a much bigger conflict, potentially bringing in a little bit more of the peers who've currently stayed on the sidelines. You bring in more peers, get them involved, and this becomes a very long-term strategic battle then. It's not just short-term. But it becomes a much more long-term strategic point, and that's where a nuclear chain reaction potentially sets off. Because right now, markets have outside of oil prices and then rates last week, equities and FX have been relatively very well contained. You've not seen the classic risk-off even to this state play out, and then that is something that actually plays out, and then it wreaks havoc on the markets.
Why haven't we seen that classic risk? Why haven't we seen that play out?
I think it's because of the nature of the way the shock started out. I'm sure a lot of people were expecting it to be a quick one and done like Venezuela. Mm-hmm. I'm sure even the US administration was expecting that. And nobody was expecting Iran to retaliate the way they have, or even expecting the kind of military strength that they have showed, that nobody knew that they had all of that. So in that environment, even now, people, given that this is a midterm election year, Trump has wanted the Fed to cut interest rates, the inflation price and prices shooting higher is not good for the administration, both geopolitically. Obviously NATO has declined to help. I think that's a very strong sign. So there's weak support both domestically and globally, which is why people were hoping that potentially this is something which is like Israel-Iran back in June 2025, where you had a shock to prices, but that lasted only a few weeks and then everything came back down. Right now, when I'm speaking to investors, they're extremely split. There's a good chunk of them still in that baseline, and some of them who have moved to that bad case scenario. But given the massive amounts of uncertainty, people are just stuck in the middle, and they have not been able to put on active risk behind any of those scenarios.
So where do investors want to go? I mean, we've been watching, the US dollar really, really closely, which we've seen under pressure, and then we saw a rally coming off of this war. So I don't know, do you have a long and short, or short and long term thought on it, and how much conviction do you have on those? Or again, it goes back to these two scenarios.
In the short run, remain defensive. The dollar should remain tactically bid. It's not just because dollar is a safe haven, and there's still a big question as to whether it has been behaving like a safe haven or not. But the nature of the shock allows the dollar to behave like a safe haven because the US is geographically insulated from all of this, energy independent, not as driven by tourism or supply chain interlinkages with the Middle East compared to the European Union. So the nature of the shock should allow the dollar to behave like a safe haven tactically, but I'm still not convinced that this dollar bounce should turn into an outright rally. And one very interesting evidence which I point out to in that is, if you just pull up the dollar chart since the start of the year, look at the dollar sell-off which happened when Trump and the US only threatened to invade Greenland, did not even invade it. And when the Fed did the rate check on behalf of the Ministry of Finance in Japan, the dollar sell-off you saw in that time was still much stronger than any dollar rally you've seen with this actual conflict in the Middle East in the last three plus weeks. So if all of this, if you get that off-ramp through the war in the summer, imagine the amount of dollar selling pressure which will come back with a lot more intensity, because the Hedge America trade will be back with a lot more reasons to justify it now.
Jayati, we're going to be speaking on our program at a little after 4 o'clock to Ed Harrison about gold, but you mentioned the dollar potentially acting as a safe haven. We've seen the opposite from gold over the past few weeks. Why is that? That's actually a very intriguing question, and I love to answer it because the gold, we do know that retail investors did get very active in participating in that market, particularly in December and January, which was responsible for the massive chunks of move you saw then. FX markets to this date have still been the most macro fundamentally driven market, untouched by retail investors or speculative moves as much. That's why FX markets to me have been the most macro moving markets in all of this, which is, I think, is a very good sign for me to make sense of when things are moving, when things look too stretched.
You mean a better indicator of what's going on?
Yes, because the move in gold did have retail investor participation, the euphoria, the momentum, the FOMO trades at some times, but that was never seen in FX.